Santiago, great to get you back. You've helped a few of us move on narratives and some understanding with, I think a lot of people are now focused on this interoperability that you introduced to many of us. But you kicked the hornet's nest the other day on Twitter talking about Ripple, of which I know nothing about, and that whole ecosystem and how you think it's probably misunderstood or has a much larger use case than people understand. So look, I'd love to learn because I know nothing about it. So you're going to have to start at the beginning and take us through this journey.
All right. Well, I'll give the trigger warning, the disclaimer. Full transparency. I don't work for Ripple. I don't contribute to the XRP ledger. I may not even be fully qualified to speak on the behalf of the technology, but I'll give it the best shot I can based on what I've learned and some of the research I've done. It's a super controversial cryptocurrency, but I think in the fairness of pragmatism and as any investor should learn as much as you can about anything and keep an open mind. So I think the goal for me today, anyway, personally, is to share what I've learned about it and then allow viewers to make up their own mind. Just a little bit of history. There's some contentiousness around the kind of validity of XRP as a cryptocurrency and some of the core principles. And I think that particularly people involved in Bitcoin have some very strong core principles that don't directly align with how XRP is structured and who manages it. So, I think we should go through that and go through the technology.
Perfect.
Okay, so I think actually to discuss XRP, it's important to discuss Bitcoin and a little bit of contrast. It's not to highlight why one might be better than the other. It's just simply to point out some differences that are important to understand. For me personally, I think blockchain technology is really about how one arrives at consensus, or how one creates a shared state, how you come to agreement on something. And Bitcoin figures out consensus, a shared state, through a process called proof of work. And other speakers on your show have talked about it extensively. But there are other ways to achieve consensus on transactions. And the fundamental problem that's being solved is called a double spend. Okay, so you can imagine a scenario where I'm going to send you a Bitcoin, and there should be no scenario in which I can then send that same Bitcoin to somebody else. And this is the idea that there's digital scarcity, and the double spend is the kind of fundamental computer science problem being solved. So in addition to shared state, avoiding the double spend is an important characteristic of a blockchain or any distributed ledger technology. So the designers of Bitcoin chose a particular consensus algorithm or set of rules in which participants in the network would arrive at consensus and avoid this double spend. And this is one of the reasons why it has the properties it does today. Is you can be sure that the Bitcoin you have in your possession isn't going to suddenly duplicate or someone's going to be able to take it. It has properties like security, immutability, these kind of things. So the creators of the XRP ledger, and that's how it's referred to, the XRP ledger, there were three creators, David Schwartz, Jeb McCaleb, and the third one escapes me now. I'm thinking here, Arthur Brito. So these guys, they pretty much were early Bitcoiners, and they said, okay, what are the things that we feel are a problem with the way Bitcoin was designed? Can we improve on the technology? And I think that's the core of why there's so much disagreement between the Bitcoin community and XRP, is because in the Bitcoin community, the creator, Satoshi Nakamoto, whoever he or she or group of people that represents, kind of made some decisions for the community and then released it to the world. And there were some changes, et cetera. But in essence, those decisions were made at inception. And the anonymity of it also is a characteristic that I think people in the Bitcoin community appreciate, right? That there's not a single beneficiary of the technology. or a disproportionate beneficiary. Okay, so long story short, the three creators of the XRP ledger decided, how can we take Bitcoin and improve on it? What kind of characteristics are we find most valuable, most interesting? So long story short, there are different computer science methods for achieving consensus for distributed systems. Now, you can imagine that there's all these computers around the world, and they're all trying to get a shared state. And there's issues like latency, throughput, all these issues, and they have to come to agreement. And at the end of the day, they have to kind of finalize their transaction and write it to a ledger so that everybody can agree on it. And this is how you avoid the double spend. Now, with the XRP ledger, it does so in a very different way. It does not use proof of work. So there aren't, miners around the world competing, hashing to try and earn a Bitcoin. There are nodes, and these nodes are run on servers, and there is a list. It's called the unified node list. And so this list is basically a list of nodes around the world that are going to arrive at consensus, right? So there's no competitive framework from the sense like proof of work. You have this competitive framework. Mm-hmm. And that's a very different philosophy for how you're going to structure a network, right? So stop me if I'm getting too technical or branching off.
Following along.
Yeah. So the UNL is a list that the participants in the network have agreed to, right? They download this file that has a list of other nodes that are considered trusted actors, right? And so there's a presumption that you're entering into a system voluntarily, right? It's permissionless, so anyone can participate in it. And there's a presumption that the other participants also want to achieve consensus, right? So there is an implicit assumption that everyone is there to play a game that is mutually beneficial. And this is very different than proof of work, in which there's an assumption that there's a bad actor, but there's also this competition, this framework. All right. So some of the key differences, and this is important for investors to know, is what are the attack vectors? What are you trying to protect your store of value from, right? Mm-hmm. So ultimately, you're trying to avoid a double spend, right? And in the proof of work system, a double spend occurs when you have, say 51% of the hashing power in the network, and you're able to rewrite the chain for some period of time, right? Yeah. And so this is the idea that you can somehow reverse transactions. Similarly, in the XRP ledger, the way it achieves consensus is very similar to something called Byzantine fault tolerance, but essentially think of a bunch of domains that overlap, right? So one person, and that person knows me, and I know a fourth person, and we overlap in our relationships. And as long as we have sufficient overlap in those domains, we can arrive at a shared state and achieve consensus. So that particular technology has attack vectors. It has ways that you can double spend. However, the threshold is much higher. It's not 51% of the hashing power. It's some majority of the network participants agree that they're going to cheat the system. Right. Now, at the core, what are you trying to do with blockchains, right? These are decentralized databases. These are shared states around the world. You're trying to sync them up in the right order. So one of the main functions is that transactions come in the correct order so that it's useful, right? So that you know that your transaction settled, that there's certainty and there's finality. Because of the way that the distributed networks work in the physical world, latency is a consideration, right? Mm-hmm. So the ability to settle transactions at certain rates, transactions per second, some put more value than others, and security might be more of a premium. So like with all things, there's not one solution, one size that fits all. There are a set of trade-offs that have to be made depending on which characteristic is most important to you. Mm-hmm. And at present with Bitcoin, the characteristic that's the most important, I would believe, is the store of value, right? That it's a secure network, and that regardless of the network throughput, you arrive at some final shared state or consensus that is immutable, right? And that everyone can rely on. And that's a extremely valuable property to have. And so there's nothing wrong with that. It's just that there are other properties for other use cases that are also important. And so the XRP ledger is a deviation from kind of that approach, right? So what kind of, I guess, getting into the controversy of things.
Yeah.
So there's a company called Ripple, and the founders of Ripple also are the founders of the XRP ledger, the developers. Okay, so they pre-mined all of the XRP right into existence. Right now, one might say, okay, that's an unfair distribution practice. All right, so when we're talking cryptocurrencies, what we're really talking about is monetary policy, right? One of the reasons that Bitcoin is an option against fiat currencies is that you have a centralized party, the central banks, whose monetary policy is very discriminate. They can decide at any given time whether to raise rates, lower rates, issue to existence with QE. And so it's very easy to, as an external actor, to criticize that because you have no control into that currency, right? You and I were born into systems that we're not given a choice as to the currency that we can use. We're just born in that country, and you have to accept the policies of the central banks or the government. So Bitcoin fulfills a very important role in other cryptocurrencies in that optionality that, I don't agree any longer with that particular monetary policy, so I want to do something different. And so Bitcoin, for example, says, hey, we're going to have a very strict monetary policy. There'll be 21 million that's ever going to be issued. And by the way, the manner in which we issue them is going to be distributed via miners. And also, by the way, we're going to enforce some kind of deflationary aspect, right? The halving schedule and the stock to flow that comes about. Now, all of that is that's still a design choice. There are no blockchains that were created by artificial intelligence. All of this stuff was created by human beings.
Yeah.
And whether you have human beings, Fed governors, and who get together in a group and decide on interest rates, or you have a human being or group of human beings that decides to design a blockchain, there's still choices, right? So Satoshi Nakamoto made some choices at inception and said, we're going to have 21 million. We're going to have this stock to flow. We're going to have the halving schedules, the mining, the distribution mechanisms. And you as a participant, you can look at those choices and say, I prefer that choice. It's transparent to me. There's predictability into the future.
Depends what you're using it for, right?
That's right. Of course, yes.
Because, for me, when I look at this and I see the debates around this stuff, it's like, well, they've all got different attributes of which they have different use cases. And I don't think there's anything else that is a store of value in the same way that Bitcoin is. And that's fine. But these other things have different trade-offs, different opportunities, and they have a value derived from the ability to use those networks or the blockchains, I guess.
Yeah, absolutely. And that's how I view it also, is that I'm a currency agnostic person, and I more approach it from a pragmatic standpoint as to for a specific problem that I'm trying to solve, what's the most appropriate use case, what's the most appropriate digital asset to use. And for the vast majority of transactions, the dollar is the best answer still, and it probably will be for the foreseeable future. And that's with central monetary policy, right? So in spite of the central banks failing as much as they are in causing inflation or stimulating the economy, it's still the best use case is the dollar, right? For everyday transactions globally.
Yeah.
So that's despite their actions. And, so Bitcoin is, and any other distributed ledger and tokenomic system, that word tokenomics, right? There's tokens and economics. That's a choice made by people, right? So one of the criticisms levied at Ripple, the company, and the XRP ledger is that all of the tokens were essentially created at inception, right? It doesn't have a monetary distribution mechanism built into it.
So meaning Ripple can push out into the community more tokens as and when they see fit?
No, not at all. If anything, the XRP ledger has 100 billion XRP tokens. Okay, and that's all that it could ever have, unless the validators on the network decide that they're going to change the code base. Right. Again, if you arrive at some consensus about the rules in which you're going to operate under, you can make those changes. That also applies to Bitcoin. There is nothing in the physical universe, there's no law of physics that says that Bitcoin can't be changed from 21 million. However, the probability of that happening is extremely low. And as time goes on, continues to diminish because the natural incentives, the game theory is that it's not in anyone's best interest to change those rules, right? Yeah. And so, the 21 million is a very as safe as a bet as you can probably make these days. But similarly with the XRP ledger, that 100 billion XRP total supply, it also is very unlikely at this point to be changed anytime in the near future, if at all. So just to give you an idea, a comparison, I looked at the total supply of XRP in circulation, and this is different than the total supply that can exist, right? XRP has been around for about 7 years, right? So it started in 2014, 2013. And in that 7 years, it's reached roughly $12 to $14 billion market cap, right? If you take the 100 billion tokens, you divide it by its current price, about 12 to $14 billion market cap. If you look back at Bitcoin, can you guess what the market cap was roughly 7 years after Satoshi Nakamoto, created Bitcoin and released it into the world? It was around 12 to $13 billion. Huh. And so what that to me is that there's more likely the effect of some underlying Metcalfe's law, where there's a network effect, and that network effect closely relates to the market cap, which is a very bulk approximation of the value of the network and the participants that are contributing. So, in terms of where we are in the life cycle of XRP compared to Ethereum or Bitcoin, it's right on track where those ecosystems were.
How does Ethereum stack up on that timeline as well, out of interest? Is it similar?
Yeah, so it's very interesting because as much criticism as Ripple, the company, receives for its kind of monetary system, it's also been a kind of a thought leader in the space. And if you didn't know, Vitalik Buterin studied very closely with Stefan Thomas, who was the CTO of Ripple for many years. And in fact, it's likely that he caught the idea of smart contracts from Ripple at the time. And similarly, Justin Sun with Tron and many other CEOs of Binance USA, that company has had an incredible impact on the crypto ecosystem. That the whole space has seen a very large impact. And many of the developers were early Bitcoiners, from 2010, 11, 12, very, very early on, who were instrumental in the development of Bitcoin. It's just that they wanted to try something that had different properties, and so sought to fix very specific problems, and we'll get into those. But that company has a long pedigree of contributing to the space in thought leadership, right? So I'm not going to make judgments as to whether or not they should be the beneficiary of the XRP as a token, as being a large holder. That's a separate issue. But with respect to giving them credit in terms of where this space is going, I just think that's unarguable. It's, they just influenced too many people, and we've seen kind of this explosion in crypto because of them. Now, that's something like Bitcoin maximalists may hate even more, right? The idea that, they could have potentially spawned off Ethereum and other ecosystems. But it's something that it is what it is. That's what we have today, and whether we like it or not. So, okay, so let's make a couple of contrasts here. Bitcoin being kind of a store of value or digital gold, Ethereum being a smart contracts platform, right? Now, Ethereum also uses proof of work just like Bitcoin. So XRP is different right from the start in the top market cap coins, in that it's the first one that doesn't really use proof of work, and that has a very high market cap, as well as an incredible amount of liquidity. And we'll get to why that, I think, is important. So, why doesn't XRP have smart contracts? That's an interesting question. So smart contracts are essentially like little programs. And one of the kind of generally accepted principles in computer science is that you don't mix your data with your programs, right? You keep those things separate and different layers for optionality and other reasons, all right? So the developers of Ethereum, just to cause a little more controversy here, they decided that they were going to mix their databases with their programs, right? That's what smart contracts essentially do on the Ethereum blockchain. Is this is a small program running on top of the database, right? Mm-hmm. And there's a couple of problems with that, which that community's discovering real time, is that when you mix your programs with your databases, you introduce some non-deterministic properties. The behavior is not always consistent. And if the main function of a blockchain or a distributed ledger is to arrive at consensus with finality, when you introduce some kind of non-deterministic aspects that arise from programs, you can get it's very difficult to manage. The amount of complexity just goes up, parabolically. So that's a trade-off. So if you want to do that, and Ethereum is doing that, that leads to other problems. We've seen that in the DeFi space with smart contracts that have unintended complexity, right? Mm-hmm. Somebody figures out an exploit or a way to drain liquidity from a contract, and all of a sudden something that looked very interesting or as an opportunity, a lot of people get burned, and that's a learning process. There's nothing wrong with that, but that's one of the trade-offs, is that you create complexity. The other trade-off is that when you build a smart contract platform on top of a proof of work system, everybody shares the pain. And what I mean by that is, if you create a DeFi product, and that product, because of its complexity, requires a lot of gas to power. Mm-hmm. Ether is the gas on the Ethereum blockchain. If that smart contract protocol or whatever say Uniswap or some other product has a high degree of complexity, you have to pay gas for that. And if you have to pay gas for that, it means that the network throughput is challenged, right? The more transactions you have, the higher the congestion in the network, which means that everyone has to pay for that. So even if you're not using that feature, if you're not using that specific composable product, you have to share in that pain, right? And so that's kind of problematic as well, right? That you're essentially socializing the pain.
Just explain, how does that pain work then? What happens in terms of gas? How does it affect a holder of Ethereum?
Well, so in a proof of work system,
or is it just the proof of work? The people who are creating the proof, it's those people who have to take the pain. Who's taking the pain?
Yeah, so the people taking the pain are the ones who want to transact, because they have to pay higher network gas fees.
Fine.
So when the network is congested, everybody's fees goes up, right? You want to get into that next block. You want your transaction processed, right? And you want to be at the front of the line.
But it doesn't hurt the holder. So anybody who's holding Ethereum, doesn't affect them. It only affects it when you're trying to transact.
That's precisely correct. Right. If you have Ethereum dormant in a wallet, of course, you're not doing anything with it. There's no cost, right? Yeah. But that gets into a very important narrative point. What is the purpose of cryptocurrencies, right? And I think that trying to shoehorn all cryptocurrencies as to having one single purpose is a mistake.
Yeah, it's wrong. Yeah.
Right. It makes sense to hold cryptocurrencies for periods of time if the main purpose is to be kind of a hedge against inflation, right? So as a store of value,
it's also a share of the network effect. So forget the store of value part of it. If you think that this network is going to go from here to here, the token allows you to participate in it, which is great. And that's all I think of them as, is, think of them as a share in the network, and do you want a part of that or not?
Absolutely. But at the end of the day, I would amend that to say, what problem does the network solve for people, right? I'm a participant in Facebook, for example. What network does Facebook solve for all of its participants? It kind of connects your friends and families together, so you can transact socially, right? Yep. So at the end of the day, the network has to solve some kind of problem for its participants to be useful, and that network value will grow.
If not, the network doesn't work. In fact,
that's right. Yeah, it's a void proposition. So now, what specific problems do certain networks solve? So Bitcoin solves the idea that there's a finite supply, and it gets a monetary hedge. It's an optionality against central banks, right? And I think it does that very well, and I think it will continue to do that. Now, Ethereum might solve the problem of decentralized finance. It might solve the problem of, completely upending the financial system because it can do these transactions without the counterparty risk of a third-party intermediary, right? So I think Ethereum is on track to doing that. I do think that they're going to have challenges
And
along the way.
it's not just decentralized finance, it's decentralized insurance, and anything that needs an embedded contract between parties. So, we're still moving down that path, but that's how I foresee it is, DeFi is just the hot topic right now, but there's an incredible amount of things that can go into smart contracts.
Exactly, and I totally agree with that. So again, I think it's important that when you discuss a single cryptocurrency, whether it's XRP, Ethereum, Bitcoin, that you don't try to always make apples to apples comparison, because maybe the problem they're trying to solve is very different. And so keeping an open mind on that is important. But going back to that conversation about the monetary policy, right? So Ethereum also has received criticism from Bitcoin community for its monetary policy, right? It doesn't have a total issuance cap, right? 21 million. There's no total number of Ether that will ever be created. However, the policy does change sometimes. If the community of programmers decides that they want to change the amount of Ether that gets created in the proof of work mining process over time, they could do that. Right? They could change the difficulty rate of the network. They can change the issuance. So ultimately, there is a group of people in real time changing the monetary policy. And if you actually look ahead in the Ethereum schedule, it's likely that Ethereum could be harder in terms of total issuance over time than Bitcoin.
And this is the ETH 2.0.
That's correct, right? So, in terms of how much rewards proof of work miners will get, and then when you transition to delegated proof of stake, what is the actual issuance rate in terms of percentages? So you can examine these individual monetary policies, and none of them are absent of counterparty risk. Right? There still is counterparty risk in these things. They're just not centralized. So a lot of criticisms levied at Ripple, the company, is that, well, they're the largest holder of XRP, right? So they represent this huge counterparty risk where they can dump into the market, and you as an investor in the token are basically exposed to that large slippage. So
what percentage do they still own?
So that's a whole nother controversial issue, but they own roughly 50% of a little. I think it's around 50%. Don't quote me on that. But what they decided to do back in 2017, because there was so many criticisms of this counterparty risk, was to put a lot of it into cryptographic escrow. Right. And so what they did is they tied their own hands with respect to how fast they can sell it into the open market. And what they did is they created a rolling 55-month escrow time lock release. So every month, a certain amount of XRP unlocks from this cryptographic escrow, and it becomes available for Ripple to do whatever it wants to do with it. It can sell it in the open market. It can provide it to liquidity providers. And then if they don't use it, what happens is that XRP goes back into this rolling window onto the 55th month. And so it's this ongoing cryptographic escrow that kind of perpetuates, right? So they're still the largest holder, but from my perspective, they're not as large a counterparty risk any longer, because now there's a code that you can audit and say, yes, there is a monetary discipline there, right? But in terms of total issuance, they don't have the ability to create any more XRP, right?
Yeah.
They no longer control the dominant number of validators.
So it's the same as Jeff Bezos and his shares in Amazon, or any of these people, is at some point they might realize it and put excess supply into the market.
That's correct, right? The difference between shareholders is they can create new shares, they can do stock splits, things like that. Whereas with the total supply known, you can't do that. All you can really do is play within that 99 or 100 billion XRP, right? That's your maximum allowance. But with respect to counterparty risk, Bitcoin, for example, 95% of all Bitcoin is in 5% of Bitcoin wallets. So it is more decentralized without argument than XRP. However, it's not to say that there isn't large counterparty risk with respect to holders, right? There are still large Bitcoin wallets that if they decide to dump into the market, that price could see significant slippage.
Like Satoshi Nakamoto's wallet.
Yeah, exactly. And there's entire programs devoted to just watching these whales and seeing their changes over time and seeing if there's any emergent behavior there. And people get very excited if one of these things goes to an exchange. They get very nervous, right? So just to be 100% transparent, every single ecosystem, because they're made by human beings, has some counterparty risk. You just need to identify what that is and decide, are you comfortable with that or not?
Yeah.
So for me, I think that XRP is one of the ecosystems that's the most transparent, right? The fact that Ripple even communicates this to the community, they have no obligation to do so. They had no obligation to put these XRP into these escrow contracts, right? So, but they did so anyway, and they report exactly how much they print out, how much they sell, right? That's another key transparency. They report exactly how much they sell. Now, Coinmetrics did an excellent analysis of their release schedule and exactly whether it matched up with their claims, and basically was able to create a curve, a monetary issuance curve, and compare it to their reported amount of selling, right? So they did a very deep dive into how accurate their claims were, and they were pretty close. There were some minor discrepancies, but both the work that they did was excellent in its analytics, but it also essentially validated for an investor that, yeah, this system is pretty much working exactly like they intended. So as an investor in digital assets, that's just one of the key steps that you need to do is to really understand who your counterparties are, what your monetary issuance schedule is, what are the rules of the game, and then to make a decision on whether it's something you want to participate in, right? So, yeah, a lot of stuff here. So what's the main problem that the XRP ledger tries to solve?
Just to ask you, what are they trying to solve?
So their main focus at this point, and by they, I mean Ripple, the company, as a kind of a steward of the ledger. And just to reiterate, the XRP ledger is run by universities, individuals, small companies. These ledgers are around the world, and they're run on server racks. They're distributed, and these ledgers are decentralized. They're not beholden to Ripple. So Ripple can't freeze your XRP. They can't tell one of the node operators what to do. But however, they're a steward, right? They do have a very strong role in the governance of the code, right? So if there's an amendment to the code that needs to be made, they're going to propose it, and then the other node operators have to either adopt it or reject it. And so they achieve consensus on how to move forward. And that's a very important aspect of a healthy ecosystem for me, is do you have a community that can arrive at consensus over changes? Are you willing to adapt to move forward your technology into the future? Because things are always changing around you. So with respect to my view of Ripple, I think their stewardship has been very good in terms of progressing the technology forward, making sure that it's secure, reliable, and transparent. So, some of the communities don't have that, right? We've seen forks in Bitcoin. We've seen forks in Ethereum. We've seen forks in some of the smaller market cap coins. And what a fork is basically a fracture in the consensus of the community. There's just a disagreement that the developers or the miners or the exchanges refuse to see past, right? And that's the origination of that fork. They just can't agree on the new rules to play by. And so, one community will spawn off. And again, those are healthy exercises at this stage of the game. Is, if we're really in the experimentation phase, which is what I think we are, I think that's a healthy exercise to see forks and to see disagreements, because then you can test out really what are the properties people.
Yeah, because the market votes on it essentially and says, exactly, we don't care about that you cared about. We care about this. And, we saw that with Bitcoin. That Bitcoin fork was prime example.
Precisely, right. There's certain properties, and I think too that because the space moves so fast, I feel that people like to rush to judgment and claim a winner and claim certain things that just aren't yet true. They could be true, but they're not yet true. And the final outcome of things is really over a much longer horizon, particularly when you're talking proto money. right? This kind of idea of it's nascent and could grow into something. It's a little, you don't want to rush to a conclusion, right? Because at this stage in the game, it's really open-ended. Anyone could emerge as, the next world reserve, for example, or, the dominant currency in the world. So just too early, I think, to call a winner. It's too new.
Yeah.
So having an open mind with respect to your what ecosystems you participate in and I believe is important. Okay, so back to the problem it's trying to solve. So XRP Ledger is specifically trying to solve payments, right? And why is it trying to do that? The consensus algorithm that it chose has a very high throughput. It's roughly 1,500 transactions per second, whereas Bitcoin has 3 to 4 transactions per second. Ethereum is, I think, 15 transactions per second, something like that. But so what does that mean when you have the availability of 1,500 transactions per second as your settlement layer? If your token has a lot of liquidity, it means that you can build some very interesting use cases on top of that. Because if you have a very fast settlement layer, then any layer 2 that you build on it can settle very quickly at the end of the day and reach that finality that's important for transactions. All right. So back to monetary policy, one of the problems we see with QE and central banks is this velocity of money going down. Yeah. And it's a very big problem with the velocity of money going down because it's not increasing the productivity or stimulating the economy. With high throughput systems, you can increase that velocity again. So, moving from, M0, T1, T2, whatever scheme you want to make for that money flow, when you have a very fast settlement layer, you can accelerate that. Mm-hmm. And so it's a perfect use case for like cross-border transfers, FX. So if you want to go from euros to let's call it a very illiquid market, I don't know, maybe somewhere in Thailand or Singapore, having a bridge currency is a very effective way to do that without worrying about your counterparty, without having treasury management, without worrying about nostro vostro accounts, basically all the problems that the SWIFT system has.
Yeah.
So cross-border transfers is kind of Ripple as a company main product that they're trying to tackle. They're basically creating an alternative to the SWIFT system. And originally what happened is that Ripple created something called RippleNet. And RippleNet is an internal company product where a bunch of banks and financial institutions, remittance providers decided on a particular rule set. We're going to agree to operate under these rules. We're going to add a compliance layer, KYC, AML, and we're going to create this bilateral messaging system. All right, so it's essentially the same as SWIFT, although more advanced. Mm-hmm. And so we're going to use blockchain technology at an enterprise scale to move money around the world without having to rely on SWIFT. All right, and so that's really the first major competitor to SWIFT in 50 years. And as you mentioned several times on your interviews, that transferring money internationally is very problematic because there's uncertainty on the transactions. It could go days in which you have the underlying volatility risk of the currencies. So everyone knows that SWIFT is broken, right? It's not really useful. But what people don't know is that in global recessions, capital contracts globally, right? It's almost like the fountain shuts off to all those exotic corridors, and the capital retrenches back to the banks where they need it for their reserves to weather the storm, right? So the SWIFT system is this system that naturally repatriates capital in a slow environment. And that's a problem for those emerging markets who need that liquidity to function. That's very problematic. We saw that with the swap lines that the central banks put in place. This need to provide liquidity into the global market to keep the engine running. Yeah. Because the risk-averse banks just don't want it.
And because the distribution of capital is held by the banks. So central banks can do what they want, but the banks are the first access point to capital. So it all comes down to them in the end. And when you've got an impaired banking system, Europe is a great example, capital doesn't go. It doesn't go out of the banking system. It's hard to leak out.
they're risk averse. They don't want to create any more exposure than they have to. So here's one of the main use cases where cryptocurrencies play a significant role is on-demand liquidity. And that's kind of their flagship product at this point. Ripple is saying, look, there's this liquidity that exists on the internet, right? Across the world. It's a global liquidity that anyone can grab at any time. And so they've decentralized liquidity. And that's a very alien concept because the way banks transact and mitigate their counterparty risk is with corresponding banking accounts. So, for example, Santander might have an account with a Japanese bank, and in that account will be their funds. And if they want to make some kind of cross-border transfer value, what happens is they just move the balance from Santander's account to the recipient's account. And so they use a messaging system, which is what SWIFT does, to initiate those transactions. Now, sometimes those messages have to go across a chain of banks. And so that's why there's very little transparency about how long it's going to take and exactly how much it's going to cost, how much slippage is going to be, because you're using a chain of relationships that are legally established, right? These corresponding nostro-vostro accounts to manage your cross-border transfers, your liquidity. So that arrangement was set up in the 1960s, right? That's nowhere near the capabilities we have today. So what on-demand liquidity does for the Ripple's product is say, look, you have this XRP in existence. The XRP has a certain amount of liquidity, right? It has a known market value. It's a transparent, permissionless ledger. And basically anybody can access that liquidity at any time. So why would you keep capital dormant in a corresponding banking account, right? If you have it there accessible when you need it, you trade into that and then you exit out of it in just in the same way you would do any other FX transaction. So on-demand liquidity is the idea of decentralizing liquidity for access by anybody, right? And this is a revolutionary concept. I don't think people appreciate it.
I don't still quite understand. Talk me through it in practice.
Sure.
Because when you say access liquidity, it means different things to different people.
Yeah. I'll give you an example. So Ripple partnered with MoneyGram, which does a significant amount of remittances into other countries. So a migrant in the United States could get their paycheck and they want to send $100 back to their family in Mexico, for example, right? So how does that work? So the recipient has a bank account in Mexico. The sender has a bank account in the United States. The sender has it in dollars, but the recipient wants it in pesos. So how do you get it from dollars to pesos? In the old way, an American bank would have to have a corresponding bank in Mexico where their dollars, they would determine the FX rate and they would swap it into pesos, right? And that's the only way to mitigate that counterparty risk. Now what happens is that those dollars are automatically converted into XRP on an exchange domestically in the US. That XRP
then transferred
is supranational, right? So that XRP is then converted into pesos in a Mexican exchange, and it's converted into a Mexican bank account, right? So it acts as a bridge currency. And how long does that process take? Well, again, it gets back to that settlement capability of the ledger. The ledger being a 1,500 transactions per second capability. That whole process takes about 30 seconds, right? So
you don't have price risk either, really.
Right. So, in FX, there's always volatility risk, right? From going from one currency to the other. But in crypto, we know there's a lot of volatility risk also, right? So you want to kind of go into that crypto and exit out of that crypto to avoid the volatility risk of the crypto. But you still have the FX risk, and that's not going to be mitigated by a bridge currency, but at least you can isolate the risk of the crypto volatility, right? But having a process that basically settles and clears in 30 seconds and has this compliance layer, that you're following KYC, AML, et cetera. That's a very important product. So now, so what does that mean to the migrant in the United States? If he has $100 that he's sending back to his family, had he used a corresponding banking relationship with a traditional provider, maybe only $95 arrives.
Yeah.
Maybe $90 arrives. If the fees are extremely high as a percentage of the total amount, and that's frankly unacceptable, and it costs people real value in their lives. Whereas if you have a product that for every $100 you send, you get $99.99, that's a big deal, right? All of a sudden, you're transforming the people's lives in a real way. So that's kind of the first real problem that crypto has solved at scale, in my opinion.
And talk people through how this is different to stable coins, because that's another way of doing it. But if I understand it correctly, stable coins just transferring the same currency from one to another. Do you still get the liquidity benefit that you would with this intermediate currency or not?
Okay, so first of all, stable coins are a broad category of different constructions. So you can have a stable coin issued by, let's say USDC, and they need to have those dollars in reserve in an account somewhere, right? So these stable coins can move around the internet virtually and with very low friction. But at the end of the day, you have that counterparty risk, right? You need to make sure that those reserves are there. So they must have some kind of proof of reserve system to transact with it. And this has been one of the criticisms levied at, say, Tether, right? That, maybe they don't have the full amount of dollars in a bank account that they say they do, or that they issued Tether into existence. Now, other stablecoin attempts like Ethereum, you got DAI, where you have an algorithmic stablecoin. This is something where you create a dollar or a euro based on a certain amount of ether on the current market price, right? But that's an engineering construction. That's like a shock absorber on a car. So if the prices move around, you need to have enough collateral so that you're not under collateralized, right? And you don't want to be too over collateralized. So that particular stablecoin construction has its own counterparty risks, right? You always have to make sure you're sufficiently collateralized to hold that position, right? And you don't want to be wasteful either. So that's an engineering problem in the smart contract space. So you got these different stable coins, and they each have their different risks, counterparty, engineering problem, whatever it is. At the end of the day, they still have the FX risk, right? If you move a dollar to somebody in Mexico, well, they still got to transfer that into pesos because that's the geography they live in, right? Maybe they'll find vendors who will accept dollars, but they live in a peso economy, right? So it doesn't solve the problem that the world has multiple jurisdictions.
So you still have to pay the exchange rate is basically the issue.
Right. Somebody has to facilitate that exchange, right? So if you send a USDC to an exchange in Mexico, let's say Bitso, I'm not saying there aren't Mexicans who won't accept it. I'm just saying that it doesn't solve the problem for the vast majority of Mexicans, certainly not the ones that are underbanked, right? The ones who are not crypto sophisticated. What they really care about is just getting that $100 worth of pesos.
And if you do it a different way, which is, let's say, create a digital swap market on top, you end up with something quite clunky, I guess, as opposed to this, because everyone's basically, as you said, going into the pool of liquidity, going in one currency, out of another, and that's fine. If not, you end up making a huge complicated layer of multi-party swaps and finding currency liquidity and all of that stuff.
Yeah, and actually, you see that criticism levied at XRP from whenever a bank comes out with a new coin, like let's say JPM coin. Well, that's going to be the XRP killer, right? Because now a major bank has created a stable coin that it's backing, it's collateralized by their dollars in their account. That's it, XRP is over. The reality is that it's not supranational. It still has the counterparty risk of the banks, right? It's not finite. So you're still subject to the monetary policy of the underlying fiat, right? So all these properties together is what you would need for kind of an XRP killer. You need the liquidity, you need the ability to mitigate the counterparty risk, fast settlement, all of these properties that we've talked about.
So where do central bank digital currencies fit into this? They feel like they're either going to replace it or work beautifully with it.
Yes, great question. So I think the biggest risk to stablecoins is central bank digital currencies.
Stablecoins are going to be tremendously under pressure because of it. But the question is whether XRP is, or whether it actually facilitates the whole system.
Exactly. And I think that depends entirely on how many corridors will XRP used in the way that I described to you. How many pairs will XRP be liquid in as a supranational currency? Right? Because again, a CBDC, a US CBDC or Chinese CBDC, it doesn't solve the problem for the Mexican worker or who's trying to receive that money.
Again, you can send dollars or yuan or whatever. You're not changing currency.
That's right. And so it also doesn't solve the monetary problem of who the central bank is and what their policies are. Right. So what a finite digital asset that supranational allows to do is address those specific problems. So I don't see CBDCs either being a killer. In fact, as we kind of move into the Ray Dalio bipolar world of yuan CBDCs and European central bank CBDCs, et cetera, what really needs to happen is you need to have an interoperable layer where you can swap these things without the counterparty risk. That's in my view, kind of the future of the entire Internet of Value, is where these CBDCs become interoperable. Now, some of them will have direct pairings, like it's likely in a very liquid pair, US to the euro, CBDC atomic swaps are possible, right? And that's fine. There's no need, may not be a need to use a bridge currency in that scenario, right? The two central banks figure out a way to atomically swap one for one dollars for euros. However, all the other countries, of which there are 130 plus, they need to figure that problem out. And if the world's reserve currency, the trajectory we're going on, if that's a problem, right? If we have the Triffin dilemma, where the world's reserve currency is problematic for not just the world, but the US, then we're going to run headlong into, well, how do all these other countries transact on a global scale?
I mean, one of the issues I just wrote down now, just thinking through, is this issue of dollar dominance, that if everybody has access to digital dollars, then nobody's going to use anything else. And before you know it, it destroys the United States and destroys everything else around it.
Yeah, I think the dollar is going to be very problematic. And we're seeing countries already starting to find alternatives. For the first time, I think there's a technological alternative to a reserve currency. This idea that a reserve currency is a necessity, I think, is becoming clear to a lot of parties that it's not. And this is precisely the ultimate promise of this technology. So when you're talking about a collateral layer, like you talked about Bitcoin being this pristine collateral layer, also true. You don't need to have a reserve currency be all things for everyone, right? You now have this the ability to have real floating FX markets, true floating FX markets that are not dependent on the liquidity of the dollar. That's a very radical concept, but I think that day to day we're starting to see more indications that that's the direction we're going into. So where does XRP fit into that? I think that it has a useful role as a supranational currency in facilitating these very illiquid corridors. I'll give you one example. In the ASEAN, in Japan, specifically Thailand, there are several Japanese banks trialing XRP right now in their FX markets and going from the Japanese yen to the Thai baht or whatever, right? And they're using XRP as a bridge currency precisely because it has the properties of being a fast payment settlement layer. So once again, going back to what properties do your crypto systems have and what use cases can you solve with them, I think it's uniquely fitted for that kind of cross-border supranational.
And so how does the liquidity, so let's say we're transferring money into Thailand, right? So we know there's a dollar XRP market, so that's pretty straightforward. Where's the liquidity in the baht XRP market?
It exchanges. Yeah, I mean, presently, I think the vast majority of XRP liquidity in these foreign exchange pairs are from domestic exchanges that retailers have bought speculators.
So you need large network effects for it to work, because if not, you're not going to reach those corners of the globe that you're trying to solve for, right?
That's correct. So how do you achieve those network effects? So locally, you can have a retail population that takes their Thai baht and buys into XRP, maybe because for whatever reason they think, hey, it's a finite currency, it's going to appreciate in value because it's a crypto, whatever it is, they inject their local economy's liquidity into it. Maybe the banks in those economies say, hey, I'd like to have some XRP, because if I have XRP, I don't need to have 6 or 7 other currencies. I don't even need to have the dollar. If I have XRP, all of a sudden it gives me access to Japan, to Mexico, to the Philippines, Brazil. By holding one supranational currency that has all of these liquidity pairs in different jurisdictions, you can all of a sudden transact at scale. And that's a global network effect, right? So the small network effects of the local jurisdictional pair between a Thai baht or peso can scale to a global network effect.
And so the value of the token itself is therefore likely to be derived not from its store of value, which we talked about earlier, but from the amount of usage.
Absolutely. And that's a key differentiator of certain cryptocurrencies, is that all cryptocurrencies have some utility aspect and some kind of monetary aspect. And the utility aspect is dictated by its performance characteristics of the underlying technology. And it's a very useful tool, I believe, for this specific use cases. Now, there are some companies trying to generalize the XRP payments use case to other things like web monetization. So web monetization is the idea that you can stream payments, right? So if something is extremely fast, reliable, and you can achieve consensus with finality, but at the same time you can abstract it onto the internet, you can start streaming payments for things. So imagine streaming content, right? There's companies like Coil and Cinnamon. What happens is, you go to a website, built into your browser are a streaming payment counter, essentially. So as you start reading that article, micropayments are coming out of your pre-funded wallet and paying for that content. Same thing with video, as on a per second basis, you can consume the video and receive back those payments real time, right? So the technology lends itself to very high velocities of value transfer. Yeah. And it lends itself to kind of this future with, information, IoT, right? Machine to machine payments, a different scale of velocity and value, right? This is a different system than what we have now. In fact, I don't think we've actually seen the potential of the use cases that you can build on top of very fast counterparty neutral settlement layers.
And let's go back to that central bank digital currency, because we know that's coming, right? They're basically announcing it as we go. So in that world, we have a digital dollar, and you're in Taiwan. It's almost instantaneous then.
That's right.
To you, because everything is electronic now, and there's no intermediary at any point.
That's correct.
That's an extraordinary difference.
Yeah, absolutely.
Global velocity of money could pick up significantly from this.
I do think it ameliorates a lot of problems with monetary stimulus, global stimulus, but also addresses that Triffin dilemma that the United States has. We know with the digital dollar project that in the U.S. there's a very concerted effort by the Federal Reserve to make sure that the dollar remains kind of the world's reserve for as long as it can. And to do so, they want to embrace this technology because it's kind of in their best interest to do so. And that makes sense. But I think many other countries can see how that's problematic for them, right? Especially when you have contraction in global trade. So cryptocurrencies, to me, are it's a way to ameliorate a lot of the incomplete global trade that we have today, right? I don't think globalism really is complete at this point. And one of the reasons for that is this friction in the value layer, this dependency on too many large counterparties. And when you use this technology to kind of expand on that, we're going to see, very, very interesting things happen.
So where's the future of banks? I don't see it. I mean, I understand investment banks, but I don't see the future of money center banks with what's going on Ethereum and this discovery of the yield curve, the store of value that is Bitcoin, the central bank digital currencies, the ability to run fiscal policy directly from government central bank to people, and then something like XRP in the middle of this. Where are banks?
That's a great question. I mean, my personal opinion is that banks are going to have to become algorithmic risk assessors. Their main function is going to be really to be either some kind of prediction market or specialist on assessing risks, and then providing that as a single service. And then what will happen is fintechs will start taking the roles of the minutia, the individual transactions, issuing a loan, setting a payment, et cetera. And you'll have more of an ecosystem of services than you will one single entity. I think in general, the trends are with decentralization, any supply chain of any kind of company that has a product will start getting decentralized, because what happens is that you can't be the best at all things, but you can focus on one very specific problem and solve it better than anyone else. And then when you have decentralization on top of that, you get this competitive framework where everyone's trying to solve one specific problem as best they can. And so really it's about how do you connect those pieces together to create a product that looks just like what a bank used to do. But in all aspects of how it does that, it's superior. So I think the banks are in trouble unless they embrace the role of being a risk assessor and not a issuer of money supply into the economy or credit. And that's been their primary role, which, I think the central banks would say that they're not very good at, right?
So to wrap this up a bit, I understand the case. I think it's super interesting, but it's a hypothesis still. So what are the markers that you would like to see to say, this is starting to confirm my hypothesis? What should everybody be looking out for? Because it's difficult to follow all the news flow. What are the things you really want to see?
Yeah, I guess, first of all, liquidity. I think it's very important that the XRP ecosystem continue to build liquidity, that you get more participants, that you incentivize people to use it, because that's when these network effects really start becoming apparent. So just, market cap going up, the volumes, the transactions going up on exchanges. I think that's very important. I think the number of use cases that the ledger is being applied to going up, and that we're seeing that. But in the real world, not the crypto world, it's pretty successful, right? 10% of all remittances between the United States to Mexico were done with XRP. And that's a big deal.
So outside of MoneyGram, who else is using it? Because I hear a lot that a lot of banks are kicking the tires and thinking about it. Who's actually using it and who's kind of sniffing around the whole thing right now?
I think, you'd want to focus on Japan. SBI is a large bank which holds a significant amount of XRP. R3, which is has a Corda as an enterprise blockchain for trade finance. They have an incredible amount of XRP, and with Corda, you're allowed to use either Swift or XRP as your settlement engine. So you've got R3, you've got SBI, you've got the Central Bank of Thailand. You have consortiums of other permissioned blockchains, right? And you have RippleNet. So it's being used at scale by people not in crypto, and that's news in and of itself, right? That to me is right. Okay. If it's actually not just a speculative experimental function, but it's actually being used in the real world to solve real problems, that to me is the most important test. So yes, it doesn't have the same amount of liquidity as Ethereum or Bitcoin right now, right, in terms of market cap. But as I started the call with, it's already on track, right along where Bitcoin is. So even as a speculator, as an investor, you might say, well, what are the upsides versus the downsides of holding XRP as a digital asset? Well, we already know it's on track where Bitcoin was in year 7. So the fact that it's being used in the world today to solve real problems, it's already using or basically going from the hypothesis stage to the use case, to the real world use. So do I think it's going to persist? Yes, I feel strongly that it's going to persist. And despite the tribalism and the negativity, more and more people are using it, that just by evidence of the volumes. Take a look at the volumes on them.
It's kind of out of the kind of crypto speculative radar screen, and it's really what it is becoming a utility, and it'll derive its value from its utility function, i.e. the more people who are using it, the more it's likely to go up, as opposed to Bitcoin, which is not being used in any other way specifically, or not many other ways specifically, as opposed to store of value, which seems to be its use case.
Yes, I totally agree. And again, those things are it's not mutually exclusive. You don't have to pick one versus the other and say that that's going to be all things for all people.
They're different things. I mean, that's very clear.
Right. And as an investor, again, it's about recognizing what your true counterparty risk is, where those risks are, and then assessing whether or not the upsides are outsized return. And that's how I look at it. if some newer technology with better performance characteristics can solve those specific problems better, I would be the first to recommend it. But until that happens, and until though even a new technology were to arrive today that does the exact same thing with better properties, till it reaches a certain level of liquidity, it needs all of these things together to really challenge it as kind of the incumbent for fast payments, supranational payments. So right now it's the king in that regard.
And is one of the features of this the fact that Ripple is going out marketing this to banks and central banks? So, there's nobody marketing Bitcoin, for example, there's nobody, but within this, you've got somebody who's going out speaking to the financial institutions saying, listen, we've got a solution. Because that helps, therefore, enterprise sales. You get more people onto the network in large chunks as opposed to relying on individuals.
That's right. And up to this point, they have relied on the retail sector primarily to drive that liquidity. But I think this, first of all, you need some regulatory clarity. I think Bitcoin and Ethereum, very clear in the United States what their regulatory position is. We're seeing that with, this Fidelity, State Street, all these other large firms saying, hey, we're going to custody banks. The OCC has provided clarity on custodying digital assets. So there's a lot of clarity with respect to Bitcoin and Ethereum in the US markets. And I think one of the things holding XRP back is that level of clarity, right? Ethereum in the beginning was issued by a very small group of people, and the SEC has clearly said it was a security. It no longer is a security because it's sufficiently decentralized. So XRP as a digital asset would need to have the same level of regulatory clarity, I think, in the US markets to reach that same level of adoption by US banks and institutions. But the world is a big place, and it's not just the United States. And there's already clarity in Thailand, Mexico, Japan, Brazil regarding XRP. And it's likely that they focus more of their efforts in those jurisdictions because that's where they'll see, as you said, more institutional adoption.
Fascinating. Look, thank you ever so much. That's really fascinating. Didn't know any of this, and it's opened my eyes up to something else again. So as ever, thank you.
Well, I appreciate it, and I don't mind being called King Shill on Twitter. So I encourage people to open their mind and be receptive to all these technologies.
Yeah, because I think that people are still fighting the last war, which was when all of these things were kind of on a level playing field and people wanted their particular ecosystem to win. But now we're bifurcating into different use cases. What problems are you solving, as you rightly put it? And that's okay. There are multiple opportunities out there, and it will not be just one. It will be multiple formats. And as you pointed out, there's going to be ones that don't exist now that will be life-changing and revolutionary. And, it doesn't surprise me. For me, I've always thought it wouldn't even surprise me if Ethereum had a larger market cap than Bitcoin, just because one is something that has a different number of use cases, and Bitcoin has less. Doesn't matter that the story. It's like saying gold should have the value of all money. Well, it doesn't because they're different layers. So so that's how I think about it. It's just going to be super fascinating. Anyway, thanks, my friend. Good to speak to you as ever, and we'll see you soon.
Appreciate it. Thank you very much.
Hey there, since you got to the end, I'm guessing you liked the video. And that's probably because we don't just turn on a camera and film. We work really hard on getting the narrative flow just right. And that's why many finance companies are actually now hiring Real Vision to make videos for them. One of our recent client videos just hit 100,000 organic views on YouTube, and there were no kittens in sight. So if you want to find out how Real Vision can make a video for your company, just email us at customvideo@realvision.com.